Greetings, everyone. This is Cathie Wood, CIO of ARK Invest. And as you know, we've been doing these videos for, well, actually since April of 2020, during the depths of the coronavirus. And as you know, since then, we went through a boom in the equity markets, and now we're in a bear market, essentially. Certainly the NASDAQ is down 20% or more than 20% from its peak. I always say to my team, it's darkest before the dawn. And I do think we're moving into some cathartic moments. We're certainly seeing the equity market rebel against what we believe is monetary policy that will end up being too tight. But before I go there, as you know, we go through monetary policy, fiscal policy, economic indicators, market indicators, and then a little bit on innovation. And this month, we're featuring something called the Bitcoin Monthly. It will be hot off the press soon after this video, and it's chock full of information and perspective about what's going on with Bitcoin in particular. And ultimately, we will be rolling out to all of crypto assets, or all of the major crypto assets, at some point in the future. But a very good place to start is Bitcoin, of course. So let's start with monetary policy. So in the last month, the Fed did tighten up. We are now in the Fed funds range between 0.75% and 1%. So from basically 0 to 25%, we have, or 25 basis points, we've now gone, if you use the high end of that range, from 25 basis points to effectively 1. So up fourfold. And the reason I'm giving that as perspective is we are beginning to wonder if one of the policy mistakes here is not understanding that we're starting with interest rates at such a low base that when you quadruple them or go up tenfold, which many people think the Fed will do before all is said and done, so going from 0.25% to 2.5%. That's a 225 basis point increase. That's up tenfold. We've already gone up fourfold. And just hearkening back to the last time the Fed was fighting inflation and ferociously fighting inflation was under Volcker in the late 70s and the early 80s. And I was there. I was just starting my career. And I remember the Fed funds rate was at 10%. And Chairman Volcker at the time jacked it up to 20% in one move. So that was up 1,000 basis points, to be sure. That's a lot. And he did it to shock the economy. But that was only up twofold. We've already gone up fourfold and potentially up tenfold. And just beginning to wonder if, the impact on the economy, starting from such a low rate and having been at low rates for so long, that maybe this is, yes, a shock to the economy. And we're seeing M2 growth slowing. It peaked, I think, at about 27% and is now down to 8% on a year-over-year basis. But if you look at month to month, what you'll find is money has barely grown at all since January. That is very tight policy already. And now we're beginning, I think just yesterday, we began something called quantitative tightening. Now, I say we, it's the Fed started quantitative tightening. And what that means is that it is going to let some of the assets on its balance sheet simply roll off. It's not going to buy mortgage bonds or treasury bonds as it has been, just to replace those maturing. Many people think that quantitative tightening is a real tightening move. I think I just described the tightening moves. The quantitative tightening is nothing more than assets on the central bank's balance sheet, the Fed's balance sheet, that are going to roll off. They were kindling for what could have been an accelerated rate of bank loan growth, but they were never lit. And so they're simply going to roll off. So we don't think that is as significant as the actual tightening moves as it pertains to interest rate and money supply. Now, one of the fights, or the biggest fight that the Fed has on its hands, it believes, is inflation. And inflation has been much higher than we would have expected. And you know the reason. Supply chain issues for much longer, almost 2 years now, more than 2 years now. And then, of course, Russia invading Ukraine, really driving up food and energy prices. So the Fed is not happy with this, and no one's happy. In fact, the consumer is very upset. Hasn't been this upset since 08, 09. But we are beginning to see signs that inflation has peaked. And Chairman Powell did say maybe it did peak in March. We got the personal consumption deflator, which is the Fed's primary inflation indicator. It's the one they pay to which they pay the most attention. The headline PCE deflator was an increase of 0.2%. So that's 2.5% at an annualized rate, roughly. And if we were back there on a year-over-year basis, the Fed would not be tightening. Nonetheless, to see that happening at the margin is really important, and the Fed should start taking some comfort from it. The core CPI, it pays more attention to the core CPI, was up 0.3%. So that's 3.5% annualized. It would like to get that down to 0.2 as well. But we have seen the year-over-year inflation rate in core PCE drop from 5.3% in February. So this measure of inflation peaked perhaps in February. March was a tick down to 5.2, and April down to 4.9. And if those sequential numbers are any indication, that rate will continue to come down over the next year or so. So the other prices that the Fed is watching, I think, are copper. Copper is a very good indicator of what's going on in the economy. And that's the global economy. We know that Europe and China are practically in recession, if not absolutely in recession. China's easing to try and take some of the pressure off. But I think oil prices might be the more important price, mostly because of how they impact consumer sentiment and inflation psychology generally. So oil prices did kick up this last month again. We still didn't get back to the peak right after Russia invaded Ukraine. Oil prices got into the 130s per barrel. And we're now down to 119, but we have been down below 100 very recently. So it's kicking back up, and it will influence the inflation metrics. Not so much the core PCE, because core excludes food and energy. And this metric was, I guess it was designed or derived in the 70s when oil and food were very, very volatile and often misleading in terms of where inflation ultimately was going to go. So we shall see what happens. Oil is influenced by a cartel. We do believe there's serious demand destruction taking place at these price levels. You can see around your own communities, there's either less traffic or that you'll see more bicycles, scooters, and so forth. And we do believe, and we've been saying this for some time, that oil demand globally probably peaked in 2019. It is the supply shock that is driving prices up. And is also going to, or has accelerated the consumer preference for electric vehicles over gas-powered vehicles. So we do believe that this oil price increase is sowing the seeds of its own demise in the form of demand destruction. And when we say oil demand peaked in 2019, we mean it peaked. Many people used to use this concept, peak oil, when they were talking about supply, thinking we'd run out of it. Instead, we are using it in the form of peak demand, the demand destruction and the shift towards energy conservation in all kinds of ways. So that's monetary policy. We think the Fed is probably overdoing it. I think that certainly in terms of its intention to go up another 2 or 3 50 basis point increases. The market's railing against that, and it is perhaps because of this very low base that I mentioned in the beginning. We've already gone up fourfold from the low, still at a fairly low rate, 1% on the Fed funds. But the market seems to be saying that this is more than just letting the markets work and letting interest rates go up. The economy may not, the global economy may not be able to take too much more. On the fiscal policy side, it was very interesting to read President Biden's op-ed in the Wall Street Journal, and his focus was inflation, top of mind. Inflation is a big deal this midterm election year, and it could make the difference between winning and losing. So his 3 answers to inflation include let the Fed do its work. Now that's really interesting. As normally, a Democratic administration would expect a little more of a dovish Fed. They'd be arguing for less restraint, but he's saying let the Fed work. And so I guess that's the Fed is an independent body, so the president shouldn't have any influence over what they do. But it is interesting in an election year to have the president saying, let the Fed do its thing, keep those interest rates going up. The second is pull the deficit down, the government deficit down. That would be more of a Republican argument. So again, a surprise. And he has suggested ways to get it down that include tax increases. We do not believe any of these will go through this year. This is a midterm election year. It's going to be very difficult to get agreement on tax increases this close to the midterm elections. And then the other ideas he has include, and this is predictable, trying to whittle down healthcare costs, especially for Medicare. That has been a weight on healthcare stocks recently, including the genomic stocks, which, again, if genomics companies can evolve cures, that should save a lot of money, but it just won't be this year. It'll be over the long term. And then he also is suggesting investing in new energy and so forth. Again, that's a longer term solution. So nothing really is going to come out of that for this year. So in terms of the midterm elections, one of the things that is happening here is investors are beginning to think about a shift to a Republican House and maybe a Republican Senate, mostly because of how badly things have gone in this year. And one of the things we're hearing is that there will be less pressure on technology and maybe more of movement towards it. For example, telemedicine in Medicare. That's a great way to reduce costs. And so we believe that the telemedicine companies are probably going to be benefited by a shift, if there is a shift, towards Republican wins in the House and the Senate. Okay, on to the economy. Well, we've had some very interesting comments on the economy by business leaders. Just yesterday, I believe, Elon Musk said that he has a super bad feeling about the economy. And we're trying to figure out what he's looking at. We know his own sales were up. Tesla sales in the month of May, I believe, were up globally 60%, and almost every other auto manufacturer sales were down, and some of them down by a lot. So it's not his own sales, except perhaps at the margin, maybe something that he's seeing in orders. He may be reflecting on the decline in total auto sales. So that's interesting. Jamie Dimon at JP Morgan talked about a hurricane. Be prepared for a hurricane. He doesn't know what kind of hurricane. Is it going to be a mild one, or is it going to be a Hurricane Sandy, which would be quite serious? But I think he's changed his tune a bit in the last month since JP Morgan reported earnings. So what is he saying? Well, he sees a lot of business activity and must see it slowing down, if I had to guess. And the president of Goldman described this environment as a confluence of shocks that in his career has been unprecedented. So again, he has a very good perspective, global perspective, every sector. And so I would say at the margin, these three business leaders are seeing the economy in some form of stress. Now, one of the issues we've been focused on with you on this video is the inventory buildup that was likely, and we'd been saying that through the last year, and it took a while to get through some of the supply chain issues, but now we are seeing inventory increases, the likes of which I have never seen in my career. And I'm talking about on a company by company basis. So Walmart, as Nancy and I mentioned in this last YouTube video, Walmart sales up 3% on a comparable store basis year over year, which means they were probably down in unit terms. Inventories up 33%, which probably means in real terms, taking away inflation, they were up 25 to 30%. Well, that's interesting because more than half of Walmart's sales are in groceries, and you're not going to see huge inventory buildups in groceries. And so what does this say for the other half? Are their inventories up 80%? It's kind of crazy to think that that's a possibility, but it's a possibility. And Target's inventories were up 42%. Now it has less in the way of groceries as a share of the total. So 42%, maybe if you X groceries, was up 50 to 60%. These are crazy numbers for two of the best managed companies from a supply chain management point of view in the world. And so maybe a Jamie Dimon is starting to see this backing up in other ways in terms of the way the information he has. Another very interesting story recently, this was in the Wall Street Journal, was one of the big Amazon seller aggregators. So basically pulling together a bunch of smaller sellers and aggregating them onto the Amazon network from a third-party point of view. In January of this year, this aggregator had planned to go public. It had such a booming conditions during COVID that it felt that this was a shift that would continue and that it could go public, and wanted to go public in order to continue to aggregate the seller ecosystem for Amazon. Well, he, instead of going public, the CEO decided the market conditions were a little hostile, but he still went ahead with the party he had planned in January. And so brought a bunch of the sellers down to Mexico. And I guess they were feeling very confident in January. Well, guess what? Just recently, that CEO was let go. They will not go public, and they may be in trouble, and they may be in too much debt. Again, so much confidence during COVID that, his business would continue to boom. So even the Amazon seller ecosystem, and these are third-party sellers, which are more than half of all of Amazon sales, even they are having problem after years of taking massive share from the brick and mortar retailers. So just thought that was an interesting story. And surprisingly, auto sales. Now, the auto manufacturers finally are getting through supply chain issues. And according to Wards, their plans were to increase production, or they're in the midst of increasing production to something like 20% this quarter. And what we got this week was kind of surprising. Auto sales dropped back down from 14.3 million. Now, steady state is 17 million. So they had not even gotten back to steady state, which is 17 to 18 million. And that's an annualized unit rate per year for the US. So 14.3, and the expectation was that that would just continue on up to a more normalized rate. Well, instead, in May, it appears auto sales dropped 12.7. So here we are again. If they build the inventory and the consumer does not come, in fact, the consumer retrenches, these companies are going to have too much inventory. What a surprise, given all the supply chain issues we've been hearing about. Now, today is Employment Friday. This is why we do this video on this Friday. There's a lot of information in the employment report. So today's employment report, the non-farm payroll was a little stronger than expected, an increase of 390,000 in non-farm payroll jobs. And if we're right, then the employment gains should be slowing down quite dramatically here. And they are slowing down. They're not in the 500 to 800,000 range per month. They are down below 400,000 now. And we think they'll continue to move down, if not negative, by the end of this year. But they are stronger than I would have expected. And as we've mentioned here before, one of the possibilities might be so many employers had been experiencing work shortages, labor shortages, that now that they're able to get the labor, they're saying, okay, even though my business is slowing down, I want to make sure I'm ready for the next cycle. So that could be what's going on. What's interesting is average hourly earnings, again, another very important inflation indicator. Average hourly earnings were up 0.3% in this last month. Expectations, 0.4%. So the year-over-year rate has gone from 5.5% to 5.2%. So again, this should assuage the Fed's concerns that we're moving into a wage price spiral. The inflation rates that we've seen in the last year do not seem to be getting into wages in a permanent way. What we did see for a while there were because of the labor shortages, wages going up to bring people out of their homes after COVID and back into the labor force. The labor force participation rate did tick up a bit after falling the previous month. The only variables in the report that I don't think got enough attention by the press and economists out there, really there are two. In the manufacturing sector, the number of the gain in employment was about half that expected, 18,000, I think 39,000 was expected. The other thing that I didn't see any mention was the work week, the average work week in the manufacturing sector went down, and overtime went down. So I think this is the first indication that we're seeing that inventories are piling up, and the manufacturing sector is beginning to retrench. The other thing we saw, and this makes sense given what I just mentioned about Walmart and Target, is the number of retail jobs dropped by 61,000. That's a pretty big drop. And then using Nancy Lazar's, so Piper Sandler's numbers, they are tallying up the number of hiring freezes and layoffs companies are announcing. And in total, since February, 61 companies, this is US-based, have announced freezes or layoffs. And just yesterday, as you probably know, Tesla said that it was going to lay off 10% of its workforce. Today, it clarified that it's not the manufacturing part of the labor force, it is the white collar. So that's pretty interesting as well. Now, the consumption indicators that have come out over the last month are quite confusing. And we've given you some of the micro with Walmart and Target and Amazon. If you look at the macro numbers that came out, personal consumption expenditures for April came out at 0.9%. That's nominal, so that includes inflation. Excluding inflation, 0.7%. So that was a pretty strong report after a great degree of sluggishness. The reason it's surprising is we also got the University of Michigan's Consumer Sentiment Index, and it fell. It fell to a new low, and we're back to where we were in 08, 09. So that is not a good place, and it's hard to understand why consumers would be spending so much. The other confusing statistic to me is consumer credit, the change in consumer credit outstanding. Now, this includes both revolving, so credit cards, and installment debt. And these are huge numbers for March and April, 37 billion and 52 billion. Normally, we're used to seeing 6 billion or 5 billion. Now, I have seen this before at turning points in the cycle when consumers or small businesses, probably more the latter, but applying as consumers, they are worried about their ability to get credit in the future. So they take down their credit lines. And we're wondering if that's part of what's going on right now. The other puzzle here is the consumer saving rate, which peaked at, I believe, 34% in April or May of 2020, dropped and has been revised down and has dropped to 4.4%. So pre-COVID, we were at 8%. We're down to 4.4%. And we haven't seen that level since 08, right around the time Lehman went bankrupt. So it's confusing. The combination of sentiment and savings, low savings, very low sentiment, the consumer would not seem to be in a spending mood. So we shall see. You know, these statistics are often revised. 1 month does not a trend make either. But that is a bit of a disconnect for us. We're also seeing housing, all kinds of housing metrics going south now. Affordability has collapsed. A combination of a significant increase in mortgage rates and pricing is pricing consumers out of the market. And consumer sentiment, I'm sure, is not helping the situation. I mentioned autos. So you've got housing and autos, two of the most cyclical parts of the economy, going down right now. The used car sales, I should also mention, are down about 20% year over year. Now we're seeing new car sales down sequentially, and they're down also more than 20% on a year over year basis. These are big declines. So we think that's going to start backing up into the price of used cars, which will then in turn back up into the secured credit instruments out there backed by used cars. The residual value of used cars and new cars will be going down if we're right and the economy is as weak as these sectors are suggesting. And now on to markets. What are the markets telling us? Equities are telling us that the Fed is going to make a mistake. And even the Fed is saying we could make a mistake. The economy could enter into recession. We hope not. There are instances of so-called soft landings. But I would submit that housing and autos down 20% is not a soft landing. You're seeing in the sectors, as equities are broken out by something called GICS sectors, energy, utilities, and materials are up. Now, energy and materials are value sectors, and they tend to do well in inflationary times. If we're right and fiscal and monetary policy are both very tight and getting tighter, then at some point this is going to flip. We will flip away from this value rotation and back to growth. And it couldn't happen too soon for us, of course. On the losing side, consumer discretionary, and of course any advertising sensitive company is getting hit here, especially on the social side, and especially with the competition from TikTok. So it's hard to tell how much of this is a competitive dynamic and how much of it is an economic dynamic. It's probably both. And of course, technology has been an underperformer. Interest rates, interestingly, as the Fed has talked in a very hawkish way, meaning it will continue to tighten, the long-term Treasury yield has had trouble getting and staying above 3%. Now, in my mind, 3% Treasury yield would be consistent. See, this is the 10-year Treasury bond yield. It would be consistent with 10 years of 3 to 4% nominal GDP growth on average. So right there, unless the economy is negative, it's very unlikely, meaning economic growth, real economic growth is negative. It's very unlikely that inflation is going to be in the 3 to 4% range. So that should be reassuring to the Fed, and the yield curve, meaning the difference between long-term Treasury yields and short-term Treasury yields, that has flattened dramatically. In other words, as short rates have gone up following the Fed and anticipating the Fed, if we're thinking about the 2-year rate, the 10-year rate has not gone up that much. And so the yield curve has flattened to roughly 30 basis points or 0.3%. That's a very flat curve. And it is typically associated either with disappointing growth impending, or lower than expected inflation, or both. And we think it will be both. And we do believe that the Fed in these next few months is going to get the message loud and clear that it cannot increase interest rates much more than it already has. We probably will see the other 50 basis points here in June. But by July, as companies are reporting earnings and talking about the future, we think the Fed will get the message. And this will be very positive for the equity markets. And this is what we're waiting for. As I always say, dark is before the dawn. We're in the bear market. Everybody knows what the problems are. And we're beginning to get signals from the marketplace that the Fed is probably going to at least start talking in a more dovish way as opposed to hawkish. We see the dollar and junk bonds and credit default swaps, all of them kind of swinging wildly in the last month, not giving us any sense of direction. We've seen commodity prices, as I mentioned, oil going back up, but not getting back to where we were when Russia invaded Ukraine. Remember, at that time, many people were expecting they were expecting oil prices to go to $200 a barrel based on that supply shock, and that did not happen. So we're waiting here. I often use the word Wile E. Coyote, or the idea of Wile E. Coyote, running, and running off the cliff, not realizing it until he looks down, and then boom. This reminds me very much of 1986. Yes, I did say 1986. Oil prices were stubborn, levitating. And, the cartel even had more power back then. And it levitated until it was clear that demand destruction was not going to allow for the pumping of oil at the rate OPEC and others were pumping it. I think the same thing's going to happen now, especially now that the U.S. Or oil producers can hide behind national security as they are starting to pump more oil. I think within the next year, we'll be up to an all-time high in oil production again, and we'll be perhaps we'll be the largest producer in the world once again. Now, I'd like to conclude. This is bleeding now into the innovation part of this video. I'd like to talk about Bitcoin. As I mentioned, we're launching the Bitcoin monthly, and very excited about it because we think the market needs this. And Yassine El-Mandra, who's our lead crypto analyst, leading our crypto effort, and David Puel, many of you may know him from his on-chain analytics work. He's created many metrics that many people are using these days, so we're so happy to have him on board as well. In this report, you will see that for the first time in Bitcoin's history, we've seen 9 consecutive weekly declines. And so when we first looked at that, I think the tendency was to say, uh-oh, that's really negative. And my question to the team was, well, could it be oversold? Could the rubber band be stretching here? Or is there something wrong? And we don't know the answer to that. So we put that in neutral category, and you'll see we'll put each of these metrics in bullish, bearish, or neutral. But we do know what happened in the last month is that Terra, the blockchain Terra, blew up, and Luna is worthless. I think I'm correct in saying that that the market cap of that ecosystem at one point was around $60 billion, with a lot of well-known advocates for it. I was surprised because algorithmic stablecoins don't make any sense to me. I have a background in economics, and I think you need the backing of something in order to have a stablecoin, and this did not. And so it didn't surprise me to see the number. I think this is the number of Luna outstanding go from in the span of a week, something like 350 million to 6.5 trillion. And I think it maybe even got to 20 trillion. So that's hyperinflation. There was nothing backing it. And I can say we would never have touched it. Nonetheless, that turmoil, that it didn't create a systemic risk. And we've been paying attention to the other stable coins out there. Are they going to so-called break the buck? So that expression came about after the reserve fund, a money market fund during 0809, broke the buck. People holding that money market fund were going to get less than $1 back for every dollar they put in. And of course, the Fed had to come and rescue that fund, because that was going to become systemic in the 0809 meltdown. But just the idea that such an instrument could exist has probably given the Fed more ammunition, not the Fed, the regulators more ammunition to regulate in this space. And the Fed could be involved in the regulation. there was about $3 billion of Bitcoin used as collateral. They had been building it up in the last month or so. And so we believe all of that was disgorged at one point. That's one reason that the Bitcoin has gone down from, in the last month, just from 40,000 to 30,000. Another reason is the high correlation with the NASDAQ. Now, interestingly, in the last week or so, that correlation broke down a bit. The NASDAQ had a few really good days. Bitcoin did not. So there's something else bothering Bitcoin. It is down 57% since its high at almost $70,000 in November. Its 200-week moving average is 22,000. So today we're at 29,000, I think. Its 200-week moving average is at 22,000 and rising. Now, the reason that particular number is interesting to us is we initiated our first Bitcoin position at, back then, it was the 200-week moving average. It was in the $225 to $250 range. So we've come a long way since then, but that has proven to be a nice support. So that's also interesting. A couple of other points I'll just highlight, and you can see in the report. It appears that the short-term holders, and you can see everything in this ecosystem. The transparency is amazing. It does appear, according to our metrics, that short-term holders have capitulated. That's very good news in terms of putting in a bottom. Long-term holders are at an all-time high at 65.7%. That means they've been holding Bitcoin for at least a year. We've got some very strong holders or hodlers here. That's also very good news. Although we might see some long-term holder capitulation to mark the bottom. And then the last metric that I'll feature, there are many more, is that the futures, Bitcoin futures, are selling at a discount to spot Bitcoin. And during those times, we expect volatility. Now, we don't know if it's up or down, but you can see from other metrics in the piece that our thinking right now, or our judgment call, is the next big bout of volatility in Bitcoin will be to the upside. Nonetheless, we are on guard. The Terra disaster. It was a fiasco for crypto, I think, in terms of raising or giving regulators even more incentive and reason to come in and regulate a little bit more with more of a heavy hand than we would anticipate. So take a look at the report. It will be coming out monthly. There'll be a little summary of what we think are the most important developments during the past month. And, again, Bitcoin, blockchain technology is very transparent. ARK Invest is very transparent. And we will be out there, giving you our point of view and explaining, what we believe is going on every step of the way. We give our research away so you understand why we're invested, how we're invested. We will be putting up in the next 10 days another of our models. We're open sourcing another model. So stay tuned for that. We intend to model certainly our top 10 stocks over time and put those models on GitHub so that you will be able to, if you disagree with our assumptions, modify them and get a sense of where the price target would be 5 years out if your assumptions are correct. And another reason we're putting these models out is because we feel that these stocks are not being covered as effectively as they might be. All we do is disruptive innovation. All of our investing and research is centered on it. And so we want to offer it up to help enlighten people who might like to know how we think the world is changing. We certainly put a lot of the top-down work out there. Now we're putting out more of the bottom-up work, so you can see the intensity behind our analysis, not just the top-down analysis, but the bottom-up analysis. And you can also see, and this is so important, how taking a 5-year point of view can change completely the outlook for a stock. When we're in risk off, everyone's time horizon shrinks to almost nothing. And if it's almost like they focus on the last 12 months. But when risk on happens again, time horizons will extend. And we hope that we will be providing you with a better understanding of how the next 5 years are going to look for lots of stocks, and of course for our 5 innovation platforms. So genomic sequencing, adaptive robotics, energy storage, artificial intelligence, and blockchain technology. So with that, I will look forward to presenting again next month, and hopefully these cathartic moments have happened and we'll be on our way again. So thanks again.